This is the paradox that confuses millions of people. If every nation on Earth is in debt, who exactly is the money owed to? The answer reveals how $318 trillion in global debt doesn't mean the money disappeared. It means it went somewhere specific, to someone specific, and understanding who holds all this debt changes everything you think you know about how money actually works. By the end of this video, you'll understand exactly who owns the government bonds, where your tax dollars go when they're used to pay interest, and why the real problem isn't that everyone owes money, it's what happens when the cost of servicing that debt starts consuming everything else. Start with why this seems like a paradox in the first place. The United States sits on $36 trillion in debt. China owes massive sums, Japan carries enormous obligations, and basically every country you can name operates deep in the red. The natural question becomes, who did they all borrow from? Did everyone borrow from aliens? Or is there some secret creditor nation sitting on a pile of cash that nobody talks about? Most people think about debt as if money vanishes when someone borrows it, but that's backwards. Here's the key that dissolves the entire paradox. For every borrower, there must be a lender. And that's not philosophy, that's basic accounting. When the U.S. government issues a treasury bond, two things happen at the exact same moment. The government creates a liability, which is an obligation to pay someone back, and whoever buys that bond receives an asset, which is the right to receive that payment. The Federal Reserve Bank of Chicago puts it plainly. In a closed economy, one person's liability is another person's asset, which means government debt functions as financial wealth for the private sector. Your pension fund holds treasury bonds, and that government debt becomes your retirement asset. Japan's government pension investment fund holds $1.6 trillion in assets, with much of it in bonds, and Japanese retirees benefit from government borrowing happening somewhere in the world. Global debt grows to $318 trillion because every dollar owed shows up as a dollar owned on someone else's balance sheet. That figure comes from the Institute of International Finance's data from late 2024, and it sounds terrifying until you understand what it actually means. 318 trillion in assets matches 318 trillion in liabilities perfectly. Someone owns every dollar of that debt, and the money didn't disappear. It just transferred from lenders expecting future repayment with interest to borrowers getting immediate purchasing power. Let's get specific and take the United States, which carries the world's largest sovereign debt at over $36 trillion, and break down exactly who owns it. 78% of U.S. debt stays domestic, held by Americans and American institutions. The Federal Reserve owns approximately $4.2 trillion, roughly 12 to 14% of total debt, through its balance sheet operations. Mutual funds and money market funds hold $3.8 trillion, which represents 11%, while state and local governments hold $2.1 trillion at about 6%. Commercial banks own $1.7 trillion, pension funds hold roughly $1 trillion, and insurance companies control $550 billion. Individual Americans own additional amounts through Treasury direct accounts and savings bonds, which means if you've ever bought a savings bond, you're a creditor to the U.S. government. Your grandmother bought you a $50 savings bond for your birthday and made you a government creditor without you even knowing it. $7 trillion, about 20% of U.S. debt, represents money the government owes to itself through what's called intragovernmental debt, and Social Security alone holds $2.7 trillion in special non-marketable treasury securities. The mechanics work like this. Social Security collects more in payroll taxes than it pays out in benefits. The surplus gets invested in treasury bonds, and the treasury takes that cash to use for general government spending. These bonds represent real obligations that Alan Greenspan testified to Congress were ultimate claims on real resources, backed by the government's full faith and credit. Foreign holders own about $8.5 trillion in U.S. treasuries, with Japan leading at $1.06 trillion. China holds $759 billion, down from a peak of $1.3 trillion back in 2013, while the United Kingdom holds $723 billion. Financial centers like Luxembourg and the Cayman Islands each hold over $400 billion, largely as custodial locations where global asset managers park their holdings. Central banks occupy a truly unique position in this debt ecosystem because they're technically government entities holding government debt, creating this unusual circular arrangement that gets weird fast. The Bank of Japan holds 46.3% of all Japanese government bonds, which amounts to 561 trillion yen, or roughly $4.2 trillion. The European Central Bank system holds over 5 trillion euros in euro area government bonds, and the Federal Reserve's peak holdings reached nearly $9 trillion in 2022. Think about what this means for a second. When the Fed earns interest on Treasury bonds, it remits most of that money straight back to the Treasury, and in 2023, that amounted to $88 billion returning to its source. Japan's debt to GDP ratio sits at 230%, the highest among developed nations, but nearly half of it gets owed to an entity the government effectively controls. Quantitative easing made this happen, starting with Japan in 2001 and accelerating globally after the 2008 financial crisis, when central banks created money electronically to purchase government bonds. This suppressed interest rates and injected liquidity into the financial system until COVID hit. The pandemic triggered unprecedented expansion as the Fed's balance sheet doubled from 4.2 trillion to 8.9 trillion between early 2020 and 2022. Quantitative tightening reversed these programs, and the Fed has reduced its holdings by approximately $1.8 trillion since June 2022. This matters because when central banks hold less debt, someone else has to step up and buy it, usually at higher interest rates that cost governments more. Virtually all nations carry government debt, but some are net creditors to the world, with their external assets exceeding their liabilities. Germany overtook Japan as the world's largest creditor nation in late 2024, with $3.99 trillion in net external assets, while Japan holds $3.7 trillion and China sits at $3.62 trillion. Japan demonstrates something fascinating here because despite its massive domestic government debt, it's been a net creditor since 1991. Japanese institutions like banks, insurance companies, and pension funds hold enormous foreign assets, including that $1.06 trillion in US treasuries, plus substantial holdings of European bonds and global equities. Germany's position reflects decades of current account surpluses from its export-driven economy that kept money flowing in faster than it flowed out. Pension funds collectively control $58.5 trillion in assets globally, larger than all government debt worldwide, and the U.S. pension system alone holds $35.6 trillion. These funds invest heavily in government bonds because they need safe, predictable returns to match their long-term obligations to retirees who need checks every month for decades. Japan's government pension investment fund manages $1.6 trillion as the world's largest public pension. The Netherlands, a country of 17 million people, punches well above its weight with pension assets of $1.74 trillion that fund Dutch retirements while financing governments around the globe. Sovereign wealth funds add another 9.6 trillion plus in assets, with Norway's government pension fund Global leading at $1.9 trillion as of June 2025. Norway takes its oil wealth and invests it globally to fund future generations, while China's investment vehicles combine for assets exceeding 2.3 trillion. Gulf state funds include Abu Dhabi with 993 billion, Saudi Arabia with 978 billion, and Kuwait with 969 billion sitting in their coffers. Norway's fund holds roughly 505 billion in fixed income securities, with about 70% in government bonds backing the promises of nations. Private asset managers dwarf even these numbers because BlackRock manages $11.55 trillion, Vanguard handles roughly 10 trillion, and State Street controls approximately 4 trillion. These big three alone manage more assets than the entire global government debt burden, and their index funds and ETFs hold vast quantities of government bonds on behalf of millions of individual investors. Your retirement account with a target date fund or a bond index fund means you personally own tiny slices of government debt from dozens of countries without ever thinking about it. Global debt grew from approximately $100 trillion around 2008 to $318 trillion in late 2024, more than tripling in just 16 years, while governments kept borrowing at faster and faster rates. The 2008 financial crisis pushed advanced economy government debt from 70% of GDP to 124% by 2020, as governments borrowed massively to bail out banks and stimulate economies that were collapsing around them. COVID changed everything when the pandemic triggered the largest one-year debt surge since World War II. $28 trillion got added to global debt in 2020 alone, pushing the total to $226 trillion, which represented 256% of global GDP. The U.S. passed 5 major relief measures, totaling $5.6 trillion in 2020 and 2021, while federal deficits hit 14.9% of GDP in 2020, the highest since World War II, when the nation was fighting on 2 fronts. Government debt now totals somewhere between $95 and $100 trillion globally, representing 30% of total debt compared to 27% in 2015. The U.S. and China together hold 51.8% of world government debt, while the top 5 debtor nations, the US, China, Japan, the UK, and France account for 67% of global sovereign debt. Emerging markets face distinct pressures as their combined debt approaches $105 trillion at 245% of their GDP, an all-time high that keeps climbing. These nations must roll over $8.2 trillion in debt in 2025, with approximately 10% denominated in foreign currencies, exposing them to exchange rate risk where a weakening currency makes their debt burden explode in local currency terms. $921 billion in net interest payments flowed out of developing countries in 2024, up 10% from the year before and showing no signs of slowing down. Interest rates stayed historically low for over a decade after 2008, letting governments borrow cheaply and roll over debt without breaking their budgets. But the Federal Reserve's aggressive rate hiking cycle changed everything overnight. Rates jumped from near zero to 5.25 to 5.50%, the highest in 22 years, and suddenly the cost of servicing debt exploded across the world. U.S. Federal interest payments nearly tripled over 5 years and reached $1.126 trillion in fiscal year 2024, exceeding the defense budget for a nation that spends more on military than the next 10 countries combined. 2035 projections show these payments reaching $1.8 trillion annually, consuming more and more of the federal budget every single year. Developing countries face even steeper burdens because they borrow at rates 2 to 4 times higher than US rates and 6 to 12 times higher than Germany's, making debt service crippling. 61 developing countries now allocate more than 10% of government revenues just to interest payments before they spend a single dollar on schools, hospitals, or infrastructure, and between 2022 and 2024, developing economies experienced net outflows of $741 billion for debt service. That's the largest outflow in over 50 years, with money flowing out of poor countries straight to rich creditors. China reduced its U.S. Treasury holdings from over $1.3 trillion at the 2013 peak to $759 billion in December 2024, a 40% decline that reflects strategic diversification. 17 consecutive months of gold purchases ran through March 2024 as China shifted away from dollar assets and toward hard assets it could hold at home. China became the largest bilateral lender to developing countries and disbursed $1.34 trillion from 2000 to 2021. Making it the single largest bilateral creditor in 53 countries and ranking among the top 5 creditors in 75% of developing nations. Belt and Road Initiative financing created $22 billion in annual repayment obligations from the poorest countries in 2025 alone, but China itself carries heavy domestic debt, with its total debt to GDP reaching 333% in 2024. We've established that the paradox isn't really a paradox because everyone can owe money simultaneously when debt is just the flip side of assets on someone else's books, but here's why this still matters enormously. Real constraints on debt aren't the absolute amounts, but the relationships between debt and GDP, between interest payments and revenues, and the stability of the currency backing those promises. Japan demonstrates this perfectly with its 230% debt to GDP ratio that would destroy most countries. But with 46% held by the Bank of Japan, interest rates historically near zero, and debt denominated in a currency Japan controls, it sustained this level for decades without collapse. Some economists argue we're thinking about sovereign debt all wrong, and modern monetary theory proponents point out that a government issuing its own currency can always make payments by crediting bank accounts. Warren Mosler, one of MMT's founders, argues that what we call the national debt isn't a debt in any normal sense for currency-issuing nations, and Alan Greenspan acknowledged this technical truth when he said, "The United States can pay any debt it has because we can always print money to do that." Critics counter with inflation risks because history overflows with examples of hyperinflation when governments finance spending by printing money instead of collecting taxes or borrowing honestly. The IMF warns that current trajectories could push public debt to 100% of global GDP by decade's end, and in a severely adverse scenario, they project 117% by 2027, levels not seen since World War II, when nations were literally fighting for survival. International financial institutions add another layer to this web because the IMF has approximately $225 billion in credit outstanding across 86 countries. The World Bank Group holds $459 billion in loans, and these institutions get funded by member nations, creating additional circular flows. The U10S contributes to the IMF, which lends to other countries who pay interest that eventually flows back through the system in an endless cycle of borrowing and repayment. Understanding who owns the debt reveals global interdependence in ways most people never consider. The US owes Japan $1.06 trillion, while Japan relies on US demand for its exports. China holds $759 billion in US treasuries, while owing Chinese households through its banking system, and European pension funds hold US corporate debt, while American investors own European sovereign bonds. Norwegian oil wealth funds education in Oslo while financing infrastructure in developing nations through bond purchases that connect a child in Norway to a bridge in Bangladesh. Here's the genuine risk, and it's not that everyone owes money, because that's just how the system works. Debt servicing costs rising faster than economic growth in many countries means the burden gets heavier every year. 3.3 billion people live in nations spending more on interest than on education or health, and the capacity to respond to future crises diminishes when peacetime debt levels are already elevated to wartime heights. When you pay taxes and the government uses that money to pay interest on bonds, that money flows to pension funds, insurance companies, foreign central banks, and wealthy bondholders who lent in the first place. Money flows upward to those with capital to lend, and the world's national debt represents wealth for those holding the assets while representing burden for those paying it back. Global public debt approaching $100 trillion isn't problematic because the money is missing or disappeared into thin air. The problem emerges if governments cannot service that debt without crowding out essential spending or triggering inflation that destroys savings and crushes the poor. So if every nation is in debt, who is the money owed to? Each other, and to the institutions that serve as intermediaries for the world's savers looking for safe returns. Pension funds managing retirement savings for millions of workers, sovereign wealth funds parking national resources for future generations, central banks managing monetary policy and economic stability, insurance companies matching long-term liabilities to policyholders, asset managers investing on behalf of individual shareholders who may not even know what they own, and foreign governments investing their reserves to protect against currency crises. $318 trillion in debt hasn't disappeared into the void, because it exists as $318 trillion in assets on someone else's balance sheet right now. Every dollar borrowed was received by someone, whether a construction worker building roads, a soldier defending borders, a hospital treating patients, or a bondholder clipping coupons, and that dollar became wages, materials, services, and returns. Borrowing created obligations for the future, but it also created assets, infrastructure, and economic activity that built the modern world. The paradox dissolves when you understand that debt and assets are two sides of the same coin, flipping through the financial system forever. Policy challenges remain real because when interest payments consume more and more of government budgets, when developing nations send hundreds of billions in debt service to wealthy creditors every year, and when the cost of past borrowing limits the ability to invest in the future, that's when the system strains toward breaking. The money went somewhere, it went to creditors, and they're expecting to be paid back.